Welcome to the Capital News. I'm your host, Alex Karitis. Today is December 17th, 2019. Thank you so much for joining me. Today we are going to be doing a continuation of yesterday's podcast in relation to some market risks for 2020. Yesterday we got through about a few of them. This again is a list that was comprised by Deutsche Bank. We did a similar exercise earlier this year when this podcast came online back in February. For 2019, it was 30 concerns that existed. For next year, it's just down to 20, but I imagine that's sort of a play on words, 20 concerns, 20 market risks for 2020. So we're going to continue making our way through that list today. But some other things before we get to that list. We discussed this yesterday. We discussed this on previous podcasts before. We said be on the lookout because it is likely that in the near future, Boeing is going to be sued. Well, it appears there's an article out there today from Reuters stating that an Irish firm is suing Boeing for lost revenue. We are not surprised here at the Capital News. We were talking about this months ago. If this whole Boeing story turned into something more serious, it appears that it is turning into something more serious, unfortunately. And so I imagine there are going to be more lawsuits as we make our way through the remainder of this year and early 2020, unless something turns around rather quickly for Boeing Incorporated, because these are big ticket items, folks. I mean, this is an airplane we're talking about. A lot of technology, a lot of materials, a lot of labor goes into this. These are not cheap tickets, so to speak. These are big ticket items, and a lot of money has been lost by a lot of companies who are really tied to the performance of this airliner 737 MAX. So keep your eyes and ears open because I am anticipating there's going to be more lawsuits coming for Boeing. Now, how hard this hits their bottom line remains to be seen, but it can be reasonably deduced that the longer that this thing plays out, the worse it will be for Boeing. So we'll keep you posted on that, but I did want to let you know that at least one Irish firm is suing Boeing with all of the fiasco that is surrounding that company. FedEx, we haven't spoken about FedEx in a while. They came out with earnings and they lowered their guidance once again. Overnight trading or after hours trading, they are down significantly. What do you want to hear, folks? This is what we've been discussing here for months. I mean, this is just further confirmation that transports lead the economy. They made a note to investors in their conference call that there is a divergence. Wow, surprise, surprise, but now you're hearing it from one of the largest companies in the world. There is a divergence between the stock market, which is bullish, these are their words, not mine, and the industrial economy. So there is a disconnect. Whoa, Nelly, stop the presses between the stock market and the underlying economy. Who didn't know this? Now, it's going to be interesting to see what type of excuses are played out tomorrow on all the financial news networks. Oh, this is just a one-off. There's nothing to see here. This is just FedEx. They got slammed by Amazon because Amazon doesn't want to use them for certain services. But nothing to see here, folks. Nothing to see here. The Dow theory, which is why we focus on transports to the degree that which we do here at the Capital News, because transports lead the economy, which should in theory lead the stock market, which is why it's called the Dow theory. We're sticking to it, just like we're sticking to the business cycle. These jackals, these fraudsters, these criminals in Washington, D.C., at the highest levels of our government, at the White House, in Congress, on Capitol Hill, and at the Federal Reserve, they can print as much money as they want. They can come out and make as many lies as they want to, and they have, and they continue to do so. They can continue to juice and prime these markets, but the day of reckoning will come. The day of reckoning will come, and that's why I say stay diversified and stay vigilant, because criminals only get away with the crime for so long. Justice, in this case, market forces, will have their way with this charade. Believe me when I tell you. That's why I tell you to stay diversified and stay vigilant. So FedEx, again, is saying there is a disconnect between the stock market and the underlying economy. Not just here in the United States, but globally, because FedEx is obviously a global player. Globally, the economy continues to slow down. No surprise to us here. We are still waiting for the Cass Freight Index to come out. Again, I am anticipating that report will come out either this week or next week. When it does, I will do a podcast highlighting the findings of that report. On the political front, we have President Donald J. Trump expected to be impeached tomorrow. But before this, he sent out an official letter to House Speaker Nancy Pelosi. It's about 6 pages long. I took the time to read it here this evening. I'm not going to read it in its entirety on this podcast. I'm actually not even going to read it tonight. There are some good points, I think, that are made by Donald Trump, but there are also things that are just flat out wrong. And then some of it will be up to your opinion, your analysis. Again, if you're somebody who sticks with him and is very supportive of Donald Trump, then you hear what you want to hear. You're going to applaud him for standing up for himself and for sticking it to the Democrats, because that's really what he went after throughout the entirety of the 6-page letter. If you're a Democrat and you're somebody who never liked Donald Trump, then this is just more wacko talk from Donald Trump. Again, we try to do the job of calling balls and strikes here. I think I do a pretty good job at that at the Capitol News. Some things, I think, the president made some good points, talking about he even called out Trump derangement syndrome, which I do think exists because people are just obsessed with the president, thinking everything that he does is going to be the end of the United States of America. That is simply not true. There are some good things that the president has done for this country, and we've highlighted those things on previous podcasts, and we give the man credit where credit is due, and we go after him and criticize him where I believe that is right. And unfortunately, more things have fallen into that bucket. And primarily, a lot of that falls down to the economy not being the greatest ever. These trade deals where we're being jerked around with false headlines and simply non-deals and things that get us back to where we were 2 years ago. So this is not really success as far as I'm concerned. Calling for lower interest rates and quantitative easing, which by chance the president happened to do again today via Twitter, saying that the Federal Reserve has to once again engage in quantitative easing and continue to lower interest rates. That is detrimental to the health of this economy and to our society, but he cares not. He just wants to juice the stock market. That's a crime in and of itself as far as I'm concerned, and that alone gives me reason to say, look, you're unfit for office. I don't care who you are. I mean, you're the president of the United States. This, to me, is beneath the office. You're supposed to focus on the health of this nation, not on the value of the stock market, especially when it comes from artificial measures of deficit spending to the tune of $1 trillion and funny money from the Federal Reserve being printed to the tune of trillions of dollars as well. And over the course of the next 2 weeks, the Federal Reserve is going to pump about $500 billion of liquidity into the market. So this is not strong growth. FedEx just told us there isn't any strong growth. There's a disconnect between the stock market and the underlying global economy. Okay. But getting back to President Trump's letter, you're going to read into it what you want to read into it, unfortunately. But if you're going to do your best job at calling balls and strikes, take your time to read it. You can find it online. Quick Google search, President Trump's letter to Nancy Pelosi. You will find it in a heartbeat. Take your time to read it. Again, he calls out the Democrats on a lot of valid points as far as I'm concerned, but then he goes and he distorts the truth, makes some falsehoods as far as I'm concerned, and you'll read into it what you will. But that can be found easily. Now, some of the market news. We have Japan exports fall for the 12th month. Thought things were bottoming out. I thought things were supposed to be getting better. They are not. Now, another thing I want to highlight here before we get to Deutsche Bank's 20 market risks for 2020. I just want to highlight crude oil here because we have WTI trading at $60.60. So we're getting close to $61 a barrel. Brent, the international metric, is at $65.90 a barrel. So we're getting close to $66 a barrel. Is the inflation starting to make its way through? Are we going to start seeing higher commodity prices? Because if this happens, ladies and gentlemen, then there goes your economy. Because if you start to see higher input costs, which we're already seeing with higher wages, and now if you start to see the double whammy of increased wages and increased commodity prices, there's going to be problems. And it's going to start showing up in hours worked, which are already slowing down, and in layoffs, which are starting to pick up, as we saw earlier when we highlighted the increase in jobless claims. Now, again, one number does not make a trend, but to see such an increase, a 2-year high, at this time of the year does not bode too well because you're supposed to see a lot of seasonal hiring, not a lot of seasonal layoffs. So we'll see if that starts to accumulate into a trend, but 1 month's number does not make a trend. So we'll continue to monitor that as well. But getting back to some of these commodities, this to me is a concern for 2020 and beyond, because I do think if Donald Trump and the Federal Reserve have their way with devaluing the dollar, which is not going to be good for you folks, but if you think it is, I guess you're deranged, but good luck to you. I personally want the value of my currency to appreciate, not depreciate. I want to go to the store with $100 and be able to buy more things, not less. But if you want to go the other way, then have at it. Support Donald Trump because that's exactly what he's calling for, and support the Federal Reserve because that's exactly what they've been doing for 100 plus years. Okay? That's why you have to get rid of the Federal Reserve. That's why you have to get rid of the federal income tax. All right? We talked about this yesterday. If it wasn't for deficit spending of $1 trillion, there would be zero growth in the United States of America. But don't worry. Don't worry. To avoid a government shutdown, they are passing $1.4 trillion worth of spending. So we're going to continue to have fake growth because we're going to continue to have trillion-dollar deficits. Hooray, hurrah. So let's make our way here to the list. I believe we left off on number 4. Number 4 is ongoing slow growth in Europe and Asia, triggering significant U.S. dollar appreciation. I can't roll this out either, folks, because I still believe that we have yet to see the worst of what we're going to witness. And with the financial mess that exists within the financial system of Europe, I don't think we've seen anything yet. I think they're going to continue to weaken. I really and truly do. Asia, I don't think we've seen the worst of their slowdown either. I don't think we've seen the worst of what's going to happen in China and in Hong Kong and in South Korea and in Japan. We talked about the list here yesterday. One of those things is the house price crash that could take place in Hong Kong, and then it could take place in Canada and in Sweden and Australia. Now, we'll get to that probably later in the week as we make our way down, but just things to keep in the front of your mind because these are likely going to transpire in some form or another. The question is when and to what degree. But we can very likely see a continuation of a slowdown in Europe and in Asia and in here in the United States, and then it becomes a question of relativity, right? Who's the best looking girl at the dance, so to speak? Are you going to flock to Chinese yuan? I highly doubt it. The people of this world aren't going to trust the Chinese. Are you going to flock to euros? Well, we don't know because there's still a lot of uncertainty, especially around Brexit, even though there was the Conservative win in the election only a few days ago. There's still a ton of uncertainty. There's been a ton of uncertainty around Brexit for 3.5 years. Just because the Conservatives won, I'm not holding my breath that there's miraculously going to be a deal that brings a huge amount of clarity anytime soon. But I will keep you posted on those updates. So where are you going to flock to? What currency are you going to go to? Probably the U.S. dollar. Not because it's the best investment, but it's just the best given the lot of the other currencies that you have to look for. Now, if that happens to be the case, and you continue to see an appreciation in the U.S. dollar because the world continues to slow down and people are just looking for the best girl at the dance, then they will flock to the U.S. dollar, at least for the short term. Well, what's going to happen there? The same thing that's been taking place for the past couple of years because this has been the story. A lot of people have been putting down the U.S. dollar, saying it was going to collapse, it's going to fail, this, that, and the other. And I've said, no, this was not going to happen because I foresaw what was going to happen around the rest of the world because this is a relative play, okay? So you're going to be looking for yield. You're going to be looking for some type of safe haven asset, and the U.S. dollar is going to fit the bill. So this has negative effects for emerging and developing economies because a lot of those economies, those countries, they have to issue debt, and they have to issue debt in U.S. dollars. And the reason they have to issue debt in U.S. dollars is because global investors are not going to trust a lot of these countries to be paid back. And if they do get paid back, which of course is what they're hoping for, they want to get paid back in a currency that carries weight. They don't want to get paid back in Zimbabwe dollars. They don't want to get paid back in Venezuelan dollars. They don't want to get paid back in Argentine pesos. and the whole list. Okay, you can just go down the list. They want credibility. They want something that's going to be recognized the world over. They want something that's going to hold that country to account. And one way in which those countries can raise debt and still be held to account is to issue debt in U.S. dollars. Okay, so if they're issuing debt in U.S. dollars, they have to be paid back in U.S. dollars. Well, if the U.S. dollar is appreciating in value, that means it's going to take more of their local currency to swap out to purchase U.S. dollars so that they can pay those those creditors, those investors who paid the whatever company who lent them the money. Okay, so if it takes more local currency, they don't have as much currency to circulate in their country for growth, for infrastructure projects, for healthcare, for anything like that. So that's why this could turn out to be problematic for emerging and developing economies. This makes sense. This is something that has been experienced over the past couple of years. We have just a mountain of global debt at the government level, at the corporate level, coming due over the next few years. So this is something that is front and center in my radar. Okay, now if there is dollar depreciation, a major devaluation, this is going to be somewhat of a reprieve for these countries who are heavily indebted with U.S. dollars. Now, we'll see what transpires, because we did a podcast a week or so ago talking about a race to the bottom. And just because Donald Trump and company, the U.S. Treasury, in conjunction with the Federal Reserve, might want a weaker dollar, we do not live in a static environment. We live in a very fluid, a very dynamic environment. So just because we might lower interest rates or go in and embark on quantitative easing or negative interest rates, that's not going to stop other countries from doing the same thing to get their currency lower as well. I don't think you really gain much from this. I think this is stupidity, to be perfectly honest with you. But again, this is who's at the helm. Stupidity is at the wheel. Central banks, federal governments, again, the only leaders that exist on this planet, as far as I'm concerned, are the people taking to the streets to protest this abuse and this corruption. Hopefully it takes place here in the United States, but time will tell. So those are the concerns with the rising U.S. dollar, that it will have ripple effects across the emerging market and developing country world, because it's going to take more of their local currency to swap to buy U.S. dollars. We will see. Number 5, impeachment uncertainty and possible government shutdown. Well, of course, there's going to continue to be uncertainty surrounding impeachment. I think this is pretty much small potatoes for the time being, unless this really turns into some sort of huge political division where it really becomes violent. Barring some sort of civil war outbreak or violence, this is pretty much not going to do anything. The market already is predicting that Donald Trump will be impeached but will be acquitted. Possible government shutdown was averted, so that's really something that's already done with. Number 6, U.S. election uncertainty, implications for taxes, regulation, and CapEx spending, so capital expenditures from corporations. This is something that's going to play out for the entirety of 2020. The clarity won't come until the election. So all of this is just a hot potato waiting in the wings as to what's going to happen. Will Donald Trump win, assuming he gets through the impeachment trial, which he most likely will, unless there's some sort of bombshell testimony that comes from somebody that we're just not anticipating. So the implications for taxes, assuming Donald Trump wins and receives maybe another big victory for Republicans in the House and the Senate, then maybe there can be some further tax cuts. Maybe on the payroll side, I'm sure that is going to be something that Donald Trump and company will be pushing for, at least rhetorically throughout the campaign of 2020, saying that, okay, well, we cut all these taxes before. Of course, most of that was catered to corporations. Now we're going to go after payroll taxes. So it'll be the same thing. It'll have a stimulative effect, mainly on the stock market, but it's going to blow out the deficits again. So there's your fiscal conservatives. I mean, we're going to have $24 trillion in no time. $24 trillion in national debt in no time. What else do they mark here? Regulation, same thing. If you get a crazy Bernie or Pocahontas in there, they're going to reverse the tax cuts if they can. They're going to put on more regulations if they can, which of course would be detrimental to the stock market and would be detrimental to the economy as well. But that's sort of what Deutsche Bank is talking about. It's sort of, at least in theory, If you got the Republicans in, there's going to be more stimulus from the standpoint of tax cuts and deregulation. If the Democrats win, there's going to be more taxation, more regulation, although there might even be more government spending, God help us. Number 7, antitrust, privacy, and tech regulation. So the darlings of Wall Street and the stock market right now are Facebook, Amazon, Netflix, Google, Microsoft, all of those people, or corporations, I should say. So if there is a big push to regulate these guys and you find them, okay, maybe there could be a pullback in their share price, which would pull down the market with them. That's too far down to even start discussing, and I think that'll be small potatoes unless somebody really gets in there and really goes to town on them. So that's number 7. Number 8, foreigners lose appetite for U.S. credit and U.S. treasuries following the presidential election. Again, that is too far down the trough. Is it something that's possible? Of course it is. Why should we wait until after the presidential election? That could happen at any time. And if foreigners do lose the appetite for U.S. credit, which they already are, by the way, then you could start to see yields spiking on U.S. treasuries, which is quite the possibility. And it's not just because foreigners lose appetite, but it's because we are not getting our fiscal house in order. So, yeah, we have low interest rates, but on an ever-increasing national debt. So it doesn't take that much to rock the boat. We've done capital economics presentations on this, that it takes an ever lower interest rate to wreak that much more havoc. Because in totality, we have that much more debt at the government level, at the corporate level, and at the household level. All right? So it's something to be mindful of that U.S. treasuries could unwind at any moment. And I think in large part that's what the Federal Reserve is doing. They're trying to keep rates as low as possible. I mean, we know that's what they're doing. But with this repo madness, this overnight lending, this temporary stuff that they're pulling off here, it's an attempt to keep interest rates low. Now, the question's going to become, how successful are they going to be at doing this with this liquidity crunch that we're going to see at year end, which happens every year end? How successful are they going to be able to control this? Now, they should not be in control of this, but we live in a centrally planned country. This is what this is. This is command and control economy. The president says we'll never live in a socialist country. Too late. We're there. We're there. And unfortunately, the president's calling for more of the control and command. Can't make it up, folks, but that's what we're seeing. So it's quite possible that there could be a loss of appetite for U.S. credit because people are going to say, we're never going to get paid back. We're not going to get paid back. So why? Why would we take the risk? And that is a legitimate concern. Number 9, MMT-style fiscal expansion boosts growth significantly in the U.S. and or Europe. So this is that MMT BS. All right. I don't know how many of you are familiar with this. We have not done a lot of discussion on this topic here at the Capital News. MMT stands for Modern Monetary Theory. There's really nothing modern about it. This is not really a theory. This is stupidity. This is basically saying, sure, central banks and federal governments, they can print as much money as they want. It matters not. Debt does not matter. Deficits do not matter. And if there's any type of inflation that should result because of this policy, all you have to do is increase taxes. This is ludicrous. This is insanity. This would be like living in Argentina. This would be like living in Zimbabwe. This would be like living in Venezuela. Do you want to go to any of those places for their economies? I don't think so, because they're either in collapse or they have been collapsing. Okay? Not good, folks. You might have a huge increase in asset prices. The stock market may take off. But guess what the cost of living is going to be? It's going to be outrageous. It'll be out of control. You think it's bad now? You haven't seen anything. Wait for MMT to come. So you have a lot of central bankers who are saying, we're running out of ammunition. We can only do so much, but they're going to continue to do so. We need fiscal stimulus to come to the quote-unquote rescue. There's only so much monetary policy can do. We need governments to step up to the plate and spend even more money. Well, clearly Congress got the memo because we're going to spend another $1 trillion that we don't have. So they got the memo to get what? 1% GDP growth? 2% GDP growth? You kidding me? That's the best we can do? I mean, at least you could have an argument and say, Alex, calm down, hold your horses. Yeah, we have a $1 trillion deficit, but we're growing at 5%, 6%. We're not even close. We have the Federal Reserve printing money like it's going out of style, because it is. We got Uncle Sam spending like a drunken sailor, because that's exactly what he is. $1 trillion here, $1 trillion there, and all we get is 1%, maybe 2% if we're lucky. Give me a break. So that's what a lot of central banks are calling for. Let's just print money. Deficits don't matter. Debts don't matter. Let's just print it, print it, print it. That's why you people better do your research and be diversified and stay vigilant and look into fiat currency substitutes, look at precious metals. You got to do your research, folks. I'm just telling you, be on the lookout because this thing could get out of control very, very quickly. Modern monetary theory is a hoax. Do not fall for it. Do not engage in it. Just remove yourself from the discussion at all costs because it is detrimental. It will be detrimental if we go down that road. And it appears that's where we're headed, unfortunately. Why? Because we have no leadership. It's easier to print the money. And maybe in this theory, maybe what could happen is instead of all of the funny money going to the government and going to major corporations and then to some zombie companies, it'll actually go into the hands of everyday Americans. Here's your money. Go spend it. And that's exactly what they'll do. And guess what will happen to the price of everything? It'll skyrocket. It'll skyrocket. So they've been complaining that there's no inflation. Do this and see what happens. Number 10, U.S. government debt levels begin to matter for long rates. So this goes hand in hand with a few other points that we were discussing. This is the market having its way with Uncle Sam saying, no way, no how. 30-year debt, I'm not taking 2%. You got to pay me more than that, pal. A lot more than that. Maybe 3%, maybe 4%, maybe 5%. Who knows? Who knows? But 2%, 2.5% isn't going to cut it. You got to pay me more. So what will the Federal Reserve do in response? Because right now they're trying to manipulate the very short end of the curve. 1-month bills, 3-month bills, that type of stuff. What happens if the longer rates start to get out of control? What if you start to see the 10-year note or the 30-year bond really start to inch up? What are they going to do? Are they going to print money to go out and buy longer-term treasuries? They probably will, because if that goes hand in hand with a loss of foreign buyers coming in to buy longer treasuries, that'll be problematic. That'll get out of hand very, very quickly. What Deutsche Bank is basically alluding to, folks, is Uncle Sam's going bankrupt. I think we're already there. But now it's just a matter of, you guys had a good run for the past 10 years as far as the stock market's concerned. You've outperformed everybody and their mother by a wide margin. Jeffrey Gundlach, who we talk about here every once in a while, has made a good point. If you look back at other parts of the world throughout history, in recent history, by the way, you see a pattern that forms. Back in the 80s, it was the Japanese. They were blowing everybody out of the water. Their stock market was just outperforming everybody. Then they crashed. And 30 years later, they're just slightly above half as to where the Nikkei was trading 30 years ago. So they're just been decimated. They've been decimated. And everybody thought they were the Mecca. They could do no wrong. This was going to continue into infinity and beyond. Well, guess what happened? Markets had their way with it. And that's exactly what's going to happen here in the United States. So you had the Japanese markets, then you had emerging markets. They did the same thing. They outperformed, and then they came tumbling down. Then you had some of the other Asian markets that were going up and away, sort of with China. They've pulled back significantly. And now you have the United States, which has carried the weight for the past 10 years as far as the stock market is concerned. Will the same thing happen? Will there be a big collapse in U.S. markets? I am anticipating that will be the reality. When that's going to happen, I don't know. I wish I could tell you because we could all make a boatload of money on timing that properly, but I simply do not know. When you have the type of fraud and corruption that exists at the highest levels of our government, again at the White House, at Capitol Hill, and at the Federal Reserve, your guess is as good as mine. We don't have printing presses. If you had a printing press, they'd lock you up and throw away the key. But it's been sanctioned by the government for these people to get away with it. And we've been through how this monstrosity, the mechanisms and how everything makes its way through the economy. Average Jane, average Joe, you're the last to get it. If you even get some of the crumbs that fall onto the floor. So that's why we got to get rid of them. But those are some big concerns that are going to be with us until they're not. And I really don't know what is going to be the catalyst to really undo these institutions. It's probably going to be another catastrophic stock market crash to sort of wake everybody up, because everybody thinks that everything is fantastic because their 401k is going up. I'm telling you to be careful here, because we are at market valuations that we have not seen since the dot-com era, and there were a lot of smart people who thought we would never get there again. And lo and behold, here we are. Only 20-some years later, we're right back there. It's quite scary how history rhymes. It may not repeat, but it certainly rhymes. So, again, those were some of the risks for 2020 from Deutsche Bank. We will continue making our way through that list throughout this week and maybe next week as well. Boeing is being sued by an Irish firm for lost revenue. President Trump is likely to be impeached tomorrow. This is a sad day for the country, regardless of whether or not you support Donald Trump or not. This whole thing is a sad day for this country. And FedEx lowers guidance once again and says there is a disconnect between the stock market and the global economy. Who will prove to be correct? Thank you so much for joining me today, ladies and gentlemen. It's been a pleasure having you as always. Please like, share, subscribe, get the word out, leave your comments. We do love hearing from you. Stay diversified, stay vigilant, and stay with the Capital News. I am Alex Karitis. Godspeed.